Hey, good morning once again, options traders, and a very special welcome to our new traders. Had quite a few who have joined us recently, so it's great having you here. And because of that, I wanted to revisit kind of an old topic, but one that escapes a lot of new traders, and that is that call options are insurance policies. And this throws new traders, and they say, well, I've always heard that call options are risky. And they'll usually say, well, I understand that put options are insurance because they give you the right to sell your shares. But what about calls? Aren't they strictly for speculation? Well, you've also heard me talk about this before, that calls are puts, puts are calls. It just depends on how we delta hedge them. So if a put option is an insurance policy, call options should be insurance as well. So let's find out why. So let's go back to the beginning and just remember what a call option is. Call options give the buyer the right to buy shares. And of course, it's for a fixed price, what we call the strike price or the exercise price, and over a given period of time. That's at any time between the moment you buy that option and the expiration date. However, there is value in walking away. So just remember, when you buy a call, it is a right to buy the shares. It is not an obligation. So if that stock price, for some reason, falls below that strike, and you go, gosh, I just would have no desire to own this stock right now, fine, you can walk away from the deal. See, if you buy shares of stock at 100 and they fall to 90 or 80 or 70, you're stuck. You can't say, I don't want them now. Sure, you could sell them, but you can't back away from that $100 purchase price. That's a sunk cost. You've already done that. But see, with the call option, we can say, I am now choosing to not buy the shares. So for instance, let's say that we buy a $100 call, maybe it's trading for 3. And if you do that, you are limiting your maximum loss to the amount paid for $3. But if you bought the shares again, it exposes you to far bigger potential losses. So here's what it looks like graphically, why a call option is an insurance policy. So here's the risk graph for long shares of stock, and I've got it crossing right here at 100. Here's our profit and loss. So we've got 0 profits and losses. That means we just paid $100. And if we look at this price right here, let's say the current market price, I could create dividing lines at various points. But let's say I don't want to take any losses below the current price of 100. What happens now, instead of 0 being my maximum loss, right? If the stock falls all the way to 0, I lose 100 points. What I'm doing is I'm shifting that ground point right there at 0 all the way up here to 100. And I'm saying I don't want any losses below 100. And so if you look at this outline right here, there's your hockey stick. There is the call option. So if we erase the rest of the graph, you can see it. So by buying the call, we get rid of all of this potential downside loss. But see, as the stock owner, we still have it. But we also retain all of the upside, just minus the amount that we paid for the option. Now, once you understand this concept that an option just partitions your stock at different prices, it will open your eyes to a lot of different strategies and to the benefits. So if we don't want any losses below 100, I could buy the 100 strike. On the other hand, if I don't want any losses below 105, then I could maybe buy the 105 strike. Notice how this blue line now crosses right here at 105. And now I'm saying I only want all of the gains above 105, and I'm willing to, in this case, have no gains until it gets to 105. So I cannot take any losses below 105, but I'm only participating in gains above. If I buy the 110 strike, it looks like this, and so on. Now I could also buy it with intrinsic value. What if I wanted to buy the 90 strike? Then my partition line, my strike, is going to cross right here at 90. And because the current stock price is at 100, it looks like there is a $10 benefit in there, right? If the stock is trading for 100 and we can buy an option that gives us the right to pay 90, there's an immediate $10 benefit. And that's why that option is going to have $10 of intrinsic value, but it will still have an additional value, the time value or the extrinsic value, because there will still be a value in being able to walk away. Just because the stock is currently at 100 doesn't mean it can't fall below 90. And so by buying the call, you've now blocked off this potential loss down here. So the main thing is to understand that call options partition your stock prices at different levels. Call options retain all rights above the strike, and yeah, your put options retain all rights below the strike. And again, this is why most people see the put options as insurance, but they miss the connection of why a call option is insurance. See, with a put, you can buy the stock now and have the right to sell it in the future if it goes against you. But with a call, you're just saying, I'm going to hold on to my cash, and if it goes in my favor, then I will buy the stock. It's really just two different ways of saying the same thing. So why is this so important to understand? Well, it all comes down to risk management. Options allow you to partition your stock prices. And that means you can focus on the risks that you're willing to take, but you can also hedge the risks that you don't want. But even better, options also allow you to manage risk as market conditions change. So at a minimum, we know that time's going to go by, in which case you'll get new information about the stock. We also know that volatility can change. We also know that the stock price can change. And so as this new information arrives, options give you the ability to manage that risk in a better, more efficient way. So for anybody who's heard that call options are risky, that's only really partially true. They could certainly be used in a risky way, but they were developed as insurance policies. And if you understand that perspective, it will help you in understanding your option strategies. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.